Welcome to Invest Well, Be Well, a podcast for wiser investing and stronger living. I'm Rusty Vanneman, longtime investment professional, and I'm joined each week by my co-host, Robin Murray.
Thanks, Rusty. I'm a storyteller and journalist, and I am so excited to explore the ideas, insights, and people shaping the intersection of performance and purpose.
This podcast is for thoughtful investors and driven professionals who want to grow in their portfolios and in their personal lives.
We'll talk long-term investing, behavioral finance, personal development, and what it takes to live and work with intention.
So let's get started. Let's invest well and be well together.
This podcast is brought to you by Main Management LLC. Since 2002, Main has been recognized as an ETF strategist that combines an institutional process with the personalized service of a boutique firm.
Invest Well, Be Well is also sponsored by State Street Investment Management. Founded as a pioneer in ETFs, State Street Investment Management, through its SPDR brand, brought the first U.S. ETF to market with a SPDR S&P 500 ETF trust, commonly known by its ticker symbol, SPY.
Our guest today is Naomi Nguyen. She's a clinical psychologist and a behavioral finance analyst at Orion Advisor Solutions. And Rusty, that was fascinating.
Oh, absolutely. Naomi is someone who truly sits at the intersection of wiser investing and stronger living. I mean, sort of the common thread of what we talk about is the behavioral aspects of investing and living and sort of the discipline that goes with it. And Naomi is clearly one of the leading voices in behavioral finance. She helps advisors and investors understand the human side of money, why we make the choices we do, especially when uncertainty is high. Her role again is a director of behavioral finance at Orion Advisor Solutions, and there she shapes how the industry integrates psychology, empathy, and evidence-based insight into real-world financial decisions. And her background is as fascinating as her work, as she combines clinical psychology with deep industry experience to help people make clearer, calmer, and more confident decisions when markets and life gets messy. And on top of that, Naomi is just one of the coolest people around. She's thoughtful, funny, and she's always bringing great energy to every conversation. So today we're going to talk about turning uncertainty into strength, building behavioral resilience, and how understanding our own minds can lead not just to better portfolios, but better lives. What were some of your takeaways, Robin?
Well, this interview was so interesting. This is one that you're going to want to listen to and slow down your playback speed because she is saying a lot and everything she's saying is really good. And you're going to want to take a note of that. Just so many nuggets and so many takeaways. As you said, we talked about uncertainty and how to sort of live with that, sit in the discomfort of uncertainty, which I think is so important to think about. She talked about being uncomfortable as a prerequisite for learning. She talked about saying, I don't know with confidence, like saying, I don't know is okay. And in this, culture of confidence, say it with confidence. Just so much stuff talking about building relationships with your clients and how that is really more of an indicator of success than anything else. Yeah, this is one you might want to listen to again.
Yeah, that's a really great tip. I listen to most podcasts at 1.3 times. And this one, I think you do need to slow down, particularly if you take notes like I often do. I had so many takeaways, and again, every word she said, there were no wasted words, and it was great. Mm-hmm. And not only was it the content, but some of her phrases were definitely keepers to use in conversations. And there was one thing I did note in the podcast, and I think it's a takeaway for really a lot of people, is we spend so much time attaining more technical knowledge, but the reality is what really helps investors, what really helps clients is the connection they have with an advisor. It isn't the technical knowledge. It is, as she says, it's the rapport. And quite frankly, spending more time on emotional intelligence is just a better way to help investors have better experiences and, quite frankly, for businesses to be stronger as well. So many good things from Naomi here. We had a lot of fun with it.
Yeah, let's listen. Naomi, welcome to the show. We're so glad to have you on Invest Well, Be Well.
Thank you for having me. Looking forward to a chat.
I am so looking forward to this for so many reasons. We have so many great questions, but the first one I'm maybe most excited about because you and I have been in multiple conversations about music. I'm not worthy to be in those conversations, but I'm so excited to hear what your walk-up song is for our podcast interview.
I beg to differ. I always feel like your submissions are great. This is a weirdly difficult question because it's so context dependent. If I'm walking out to my car for a night drive, I'm definitely picking something different than if I'm walking out to face a firing squad. So I did have to think about this walking out to a podcast. But I'm going for ESG, My World Is You, because the baseline is undefeatable. What do you think?
I love that phrase, undefeatable. That's right. It's perfect. Well, cool. Well, in your own words, Naomi, could you tell us a little bit about what you do at Orion Advisor Solutions?
Yeah, definitely. I work alongside Dr. Daniel Crosby on the behavioral finance team, sort of building out practice management things in a number of different ways. Some of the dimensions of our work include kind of working with advisors or clients directly around different communication strategies, behavioral kind of informed techniques of how to be more client-centric in kind of helping people make the best decisions.
Great. Well, Robin and I have so many questions, and we had to play musical chairs on some of the questions. So this podcast easily could have been 2 hours long. So the very first question is a big topic of yours is uncertainty. And you've talked about uncertainty being the only guarantee. So how should a high-performing investor or leader reframe uncertainty so that it becomes a strength rather than a liability?
I think it's interesting is when we talk about liabilities, it's almost as if it's, there's an implication that there's inherent kind of negative risk happening. But the reality is that almost anything can be a liability if we're not handling it correctly. If we think about love, it sounds like a good thing. It's also a massive liability. So I think things tend to become liabilities simply when we're resistant to aspects of them. We're kind of moving half blinded through working with something, or we don't have the tools to adapt to an unveiled blind spot. So uncertainty is, it's neither good nor bad. It just is. It's a feature of life, but it does become a liability if we have that proclivity to resist it. So I think to answer your question on reframing it, uncertainty being treated as if it's just naturally a liability would be like saying being alive is a liability, which is, it's entirely correct, but not necessarily helpful. So if we think about uncertainty in terms of how we break it down psychologically, it's something that's ambiguous, it's novel, it's unpredictable. We want to embrace space to make meaning in that. If something's ambiguous, that can be a little scary. And also it gives us space to make meaning. If something's novel, it's new, maybe we don't know what to do with it, but we do get to determine our own commitments. If something's unpredictable, it's a chance to kind of figure out how to trust ourselves to work in that area and accept our shortcomings. So I think I'd reframe it in those ways if that answers your question.
Yeah, it's great.
So what do you see as the most common derailers for investors when things get difficult, right? When markets are turning volatile? How can advisors and leaders build resilience ahead of whatever next shock is coming?
Yeah, I like this question. I think the common derailers when things are a bit volatile or unknown are sort of the derailers that could just throw us off anyway. So for example, they're just sort of amplified in those situations. Mistaking the anxiety of uncertainty as a prompt to suddenly rearrange our entire value system is one. That's just a common derailer. I think that gets thrown into higher relief when things are scary. Or getting really myopic and zooming in at the here and now and losing all kind of sense of historical lens or long-term perspective. That's another one. I think falling prey to false certainty or false prediction rather than just sitting in the discomfort of uncertainty is something I think that crops up a lot. And I think being able to build that resilience, buffer yourself against it, would be to learn how to sit with discomfort. Being uncomfortable it's just a prerequisite for learning, neurologically speaking. And not all discomfort is a symptom of growth, but all growth requires passing through discomfort. And so I think being able to build your tolerance there would be vital. If it's comfy, it's because it's familiar. That means we're not shaping new growth. We do need the familiar, but we're not experiencing that. That can be a little bit of a shock to our system. So trying on new perspectives, building resilience, being able to take the long-term perspective, being aware of your reactions rather than reactive to them. Those would all be ways to kind of insulate against those derailers, I think.
So how do we help people do exactly that? Sit with uncertainty without rushing to false certainty and other sort of coping strategies, especially in investment decisions where the culture tends to reward confidence, right?
Yeah, definitely. I think the response there would be learning how to say, I don't know, with confidence. And I'm kind of joking, kind of not. I mean, there's a self-awareness that, we don't know what we don't know. And that's something we can actually be really confident in. And it's important to be able to sit with that in confidence and not in a stagnant way. So I think when I speak to that, I should maybe clarify I think stagnancy is equivalent to illness. So sitting with ambivalence is some sign, waiting for some sign to kind of move you. It's the same as rumination. Perseverating on a problem is a substitute for having the courage to take steps and see what works or doesn't work. So when I say sitting with I don't know, I don't mean just sitting in I don't know and throwing our hands up. It's sitting with I don't know and accepting that discomfort and then saying, using it as a pause to reassess before trying to find out. So having, and that requires a lot of courage, really courage to ability to, self-correction, so that I don't know becomes less paralytic. And I think having the courage to say I'm wrong when you're wrong is really antithetical to that culture of confidence you talked about there. So in a culture where everyone has to have an opinion on everything, I mean, you can log on to X, the everything app right now, and see thousands of people who are confidently wrong. And being able to be wrong from a place of I'm learning rather than a place of entrenchment, I think would be key to answering the question.
So when you speak or write of behavioral finance easing stress, what are some of the key levers you've seen advisors use to move clients from feeling that they're just invested to feeling like they're living well?
Yeah, the research and literature indicates that advisor value is being increasingly determined by clients. So clients really want to have advisors understand how they define the idea of a meaningful life on their own terms, have things be personalized to them. And that's how advisors are essentially able to demonstrate their value there. So I think as an advisor, if you're able to learn how to understand your client in the context of their own life, by having the sort of communication skills and behavioral infused kind of approaches and techniques to discovery, for example, or having kind of psychoeducation around this, the ability to explore other options with your client, these will all be key levers, I think, of helping your client feel understood. And if your client feels understood, the plan that you're able to make is going to track a little closely with their experience compared to otherwise. And I think that certainly catalyzes that move from being just invested to kind of feeling like you are cohering wealth and well-being in a way that makes sense.
Now, earlier you talked about sort of the importance of the ability to say, I don't know. But in our culture where confidence is rewarded, what role does vulnerability play in decision-making? And how does that map into investment behaviors and life behaviors?
Yeah, I love that question. I think vulnerability is, if I was going to put a working definition to it, it would be the ability to stay connected to the fact that we're not immutable, which becomes a strength. Because if we reverse that, if you have somebody who refuses to admit that they have any sort of vulnerability or, fragility, they actually become more brittle and more fragile. And so I think that, you have a less thought out approach if you're not able to accept that part or integrate the fact that we're vulnerable. And vulnerability requires we acknowledge every decision is a double-edged sword in the sense that every time we say yes to one thing, we're saying no to something else. So when I think about life, generally speaking, and I can speak to investment, the application to investments as well, but in life, we'd have to really breathe the lives we haven't lived in order to embrace the life we're living. And I think this is true everywhere. There's sort of a limit to hedging bets or having your cake and eating it. And I think trying to pursue that really fractures us. So trying to move in a direction where we're not vulnerable, we're not taking that into account in the contradiction of being alive and having to make decisions, we end up getting fractured. So I think being able to recognize you're vulnerable is recognizing that we have to make choices because we have to move in certain directions. But making a choice means we might lose something else, which is a very vulnerable feeling, that you can't have total control over destiny and just bend it to your preference or whatever else. But I think that's such a wonderful thing. So in this culture of high performance, we need to acknowledge losses. We need to acknowledge that's going to be inherent to being alive. We're always vulnerable to loss in investments and life, and that's vital. And I think it is tricky socially because we are in a bit of an era of grift, I think, an era of misinformation, the idea that we can buffer against vulnerability, we can have it all, we can have community while we're also having self-interest, we can have total intolerance for the people, and we're just going to reframe that as self-care, we can have love without compromise or exposure. And I think that, if that's the cultural tenor that we're in, it becomes really difficult to really feel connected to that sense of vulnerability. So I think we think about life, that's just true, and we think about investments, being able to account for the fact that there will always be losses in some area, whether that's opportunity costs or whether that's quite literally a loss. This is just part of life. I think accepting that's actually a huge strength.
So in your work, you say repairability trumps compatibility as a predictor of the endurance of relationships. So it just makes me think of Dr. Becky, the parenting guru, that often talks about repair in relationships, which is really great. But how does that manifest in portfolio teams or investment firms when talking about repair?
Yeah, it's a good question. I think the idea of compatibility, if you don't mind, I'll expand on that a little bit. I find it really interesting. Compatibility can mean, it's almost like a specious term in some ways. It can mean anything. It can mean you're complementary. It can mean you're different. It can mean you're identical. It can mean you're in agreement. It can mean all kinds of different things. So in a sense, if compatibility is everything from being identical, the same, or really, really different and just work well together, what makes the differences between two people doable or not? What makes that compatibility? And I think that it is repair. If we think about, I suppose relationships would be the easiest place to start with this. Compatibility is often really overrated in terms of estimating how successful a relationship is going to be. Not because compatibility isn't something to think about, but sometimes it can be used as an excuse to not do the work to cohere edges that could actually be entirely complementary, because difference, of course, inherently isn't the problem. And, difference can sometimes pair really well to catalyze a truly remarkable locomotion. So I think just relying on compatibility alone as if it's a standalone quality would be a little bit misleading. But having differences that you don't know how to repair or work with, that can be more of kind of that liability we talked about earlier. So being able to repair, I think, what you alluded to there with relationships, with the ability to sustain a relationship and sustain progress through rupture. So if there is some kind of rupture that occurs, how do we address it? How do we address it as honestly as we possibly can? How do we have the rapport enough to get through that rupture and still be friends afterwards? And I think in some ways there's it's a positive feedback skill for a team to have. It's the way that we would cohere everyone's different skills and kind of put them together into something transformative. And it softens those edges between different personality types, different approaches. If you think about having a team where everyone was just identical, everybody agreed all the time, everyone had the same perspective, the same experience, you're not going to get the richness of all those different perspectives, the expertise, any of those things. Now, if you have a team where everybody's different, everyone's from a different walk of life, you're going to have edges that rub up against each other, but you now also have this incredibly three-dimensional thing you can work with, which is extremely advantageous for having a multidisciplinary team that can think through things from all different angles. But that repair becomes really important to have the behaviors shape best practice, I think.
So what can firms do to really engineer better investor behavior and better decision-making behavior, whether that's among their partners, analysts, advisors, anybody that they're working with?
I suppose in asking that question, the first thing I think about is my experience working with kids actually in school systems. You have to set people up for success. I'm not saying your advisor team is like, you shouldn't treat them like children. I'm not saying that. But when I think about, children in terms of learning new skills, kind of developing, I think about setting up for success. If you have kids in a classroom where it's just a free-for-all, they don't really understand the rules, what's expected or anything else, they're going to have a hard time kind of climbing that lattice of skills. And so I think there's a responsibility for teachers there to really set them up for success, clearly outline what's expected. You almost like set up little behavioral bumpers so they know what to expect and get feedback in real time that's developmentally appropriate. And then as they get older and more advanced, there are fewer scaffolds because they start putting them in for themselves. And so when I think about that kind of behavioral architectural standpoint, I'm thinking about how do we set our teams up for success? So we have to have kind of the framework they're working within, be really clear, be really understood, have feedback, be relevant to different decision-making processes. And I think without having that clarity and of agreement on objectives or values, that's where things start to get messy. I think another thing too would be that once we've had those conversations about what's expected, what do we value, what's the kind of target here, every decision we make is not now a standalone thing where we're having to like go through the process over again, which leaves more room for errors. We're working backwards from the overall big picture together. And I think that's a clear in architecture.
This episode of Invest Well, Be Well is brought to you by Main Management LLC, a pioneer in actively managed ETFs since 2002. Main Management starts with a clear fiduciary focus, delivering the transparency and personal attention you'd expect from a boutique firm. They provide financial advisors with solutions, not products. Main also believes investors should keep more of what they earn, emphasizing net of fee after-tax performance to help clients retain more of their returns. I've known Main Management for years. I've met thousands of managers over the course of my career, and one quality I really value, they invest alongside their clients. They eat their own cooking. Over 10% of the assets they manage are their own partner assets, and more than half of the firm are partners themselves. That says a lot. To learn more about Main's strategies, including buy right hedged equity, U.S. sector rotation, thematic innovation, and all asset models, please visit their website at mainmgt.com. Unrelated to Robin's question, but it's sort of like the classic problem many advisors have is many advisors struggle with the gap between what clients say they want and what they actually do. So what behavioral tools or frameworks do you recommend to kind of close that gap?
Yeah, this is such a key struggle, I think, for everybody, not just advisors, in almost every career. Whether you have somebody going to the hairdresser saying, "Oh, I want this haircut." Well, do they want that haircut or do they want how it looks on this particular person they're showing a picture of? There's always, in anything from that to what we think we want in a partner, to what we think we want for dinner, there's often a massive gap between what we're able to verbalize wanting and then what actually satisfies us. And so I think something to start with is normalizing that. One of the biggest barriers that we see from people going to their advisors with honesty and obviously struggle to kind of make good calls if you don't have all the information is shame. That's one of the biggest barriers that we found. So being able to normalize the fact that this gap exists and we're going to navigate it together is the first thing I'd say. There's something in psychoanalysis, which is what I was kind of working in during my master's degree, where Freud talks about the idea of the ego not being the master of its own house, which I think is true for just humans generally, that, and that speaks, I think, to that gap between what we think we want, what's good for us, and then what we do, which I think, in behavioral, it's talked about as value action gap. That's normal. Normalizing, that's helpful. Reduces shame. Client comes in, we can have that conversation now because now we've added a little bit of texture. We're saying, okay, this is what you're saying you want. Amazing. What I'm noticing is that there are a couple of things in the way, like your contributions are not as consistent with that goal, for example. That might be an area we could kind of pull out a little bit and look at the gap between those two things. I think, having that gap is normal again, but it's not healthy unless we're examining it and massaging that into a position that's more coherent with our value system, for example, or getting frozen in that gap. So being able to speak to it without that shame and having curiosity around it is really key. Something that I talk to advisors a lot about is the idea of making sure we move from having our client be in a position of sort of paralysis in that very normalized state of having the value action gap to curiosity. So having the advisor be curious and helping the client get curious around your own behavior and recognize the social levers that are at play. So whether you're someone who is kind of moving in a slipstream of mimetic desire or familial or cultural expectations, whatever it is, recognize those levers at play and normalize the fact that we're social beings. We're absolutely going to be kind of vulnerable to those things. And I think on a more sort of sociocultural level, recognizing that our desire so often takes the shape of the consumerism that, it's the water we swim in. So it's essentially what capitalism is. It takes our desires, it shapes them, and then it sells them back to us. And so it's not always necessarily what's best for us, it's just how it works. So recognizing the water we swim in, acknowledging that's what we're vulnerable to, and then being a little more deliberate around the kind of swimming strokes we're taking is really what I would say to advisors in that situation.
All right. Another question is a lot of people talk about money personas or kind of how they make decisions, financial decisions or investment decisions. How do you get beyond personal financial statements and the spreadsheets and the quantified risk scores to get to that deeper money persona, again, that decision-making profile, so that advice becomes truly personalized and sticky?
Yeah, moving beyond that spreadsheet, I mean, the idea gets tossed around. What's the phrase that they use? It's sort of like tending to the person, not just the portfolio. That kind of phrase is certainly gathering steam because it's exactly what you're talking about. If you're not able to do that, the plan's not going to be sticky. The plan's only as good as your ability to stick to it. And that's true of anybody, I don't know, maybe starting an exercise regime, whatever it is. And so being able to do that, I think, is going to really define how advisors are able to move into the future of the financial landscape. And I think it starts with just being able to be authentically interested in your client. And this is something that I can transfer over from clinical experience. There's studies done that demonstrate that a therapist's ability to have really, really good rapport with their client is actually a better determinant of the therapeutic outcomes than what kind of modality the therapist has, whether they're CBT, psychodynamic, whatever else. That's actually a weaker predictor. And so I think advisors being able to truly be interested in their client, care about their client, have genuine, authentic rapport, real curiosity, and lean into that is going to be a really good predictor of how well they're able to move beyond the spreadsheet. And it doesn't always have to be just naturalistic. I mean, it can be cultivated, but being active to that cultivation, asking what brings them joy, looking for little clues about how they live their life, being interested in, do they have family? Do they care about family? What do they like doing in their time when they're not working? Things like that would be important before we really get to kind of breaking down, what are their habits, what kind of financial goals they have, things like that. There are a lot of behavioral finance tools out there that I think are becoming more coherent and integrated into advisory practices. But I think that focus on genuine and authentic rapport is a big one.
It is really fascinating that rapport and emotional intelligence are really more important to financial advisors, both in terms of, first and foremost, creating better investor experiences, but also is better for their business than just taking another continuing education course on the markets and the economy. It's really kind of a fascinating thought.
Yeah, it's true too. Yeah, for sure.
So when an advisor is growing their firm, how would you suggest that they weave some of those behavioral questions into their work on prospecting and also during the onboarding process?
I think intentionally would be the short answer to that. I think it can get really easy to be in problem solver mode. Often people are seeking out their financial advisor at some inflection point, where they're experiencing a change or they are in distress. There's all kinds of reasons for it, but being able to recognize that the behavioral part is a foundational approach to all of the above is going to be important too. I think weaving the questions in intentionally means thinking about the emotional underpinnings, the tone, the body language, all kinds of different parts of how you engage with somebody is important. And I think making sure that we sort of do almost like a pre-mortem on a discovery process would be a big part of that. Making sure that we're not just asking questions tied to numbers or things we want to report out on, but starting with cultivating that rapport. So I think intentionally would be the short answer to that question, making sure that you're deliberately infusing your practices with that.
Yeah. What role do you think that advisor self-awareness plays in forging trust with clients, especially when the behavioral lens is applied to the advisor as well as the client?
Yeah. I think a framing to that might be to remember that money is sort of the material underpinning for how we live so much of the rest of our lives. Any existential questions your client's dealing with, money is going to be a big part of how they kind of live there every day, and that can dictate aspects of how they approach those bigger philosophical questions. So being closely attuned to the fact that, yes, we're looking at money, but that the conversations we have with our client are going to draw those lines between how the client makes a living and how they make a life. So staying closely attuned to the fact that that's the conversation we're often having with clients is a big one. I think that helps advisors stay in problem-solving mode appropriately, so that we're framing that as, yes, we're solving a problem, we're talking about money, we're talking about the future, and not talking about numbers, and we're also talking about emotional value that those numbers reflect. And being able to kind of suspend those, you do need to have best judgment, of course, in an advisor, but being able to suspend the sense of judgment while you're kind of discussing those things would be important. One reason why I say that is because I think a lot of human behaviors, it's really irrational. I think we'd love to think of our decision-making process as very rational. We're all very sensible human beings. But the reality is that humans are just not particularly rational creatures all the time. And I think being able to suspend that problem-solving sensibility enough to not just jump to, that's irrational, that doesn't add up, this doesn't make sense, to, hey, what's going on over here? And this, if it's not something that's best practice, is helpful. Just making sure that we're kind of able to suspend that sort of impulse to jump in and say, this is not conducive to what you said you wanted, let's go over here, would be my answer to that, I think.
So the primary theme of our show is wiser investing, and we've just covered a lot of that ground. But the other theme of our show is the idea of stronger living. And quite frankly, I think they're both connected. But in your view, how do habits in physical fitness, mental health, social connection, all intersect with investment behaviors? Are there behavioral patterns, either in the gym or in recovery, that echo patterns in portfolio behavior?
Yes, I would definitely argue yes. And I think I occupy a very authentic position to make this argument as somebody who's kind of in their infancy around adopting health and fitness practices and routines. I'm not kind of aggressively sedentary, but I've started learning, getting to middle age, that fitness is just not adequately tended to by the occasional walk or the sporadic yoga class. And so I'm recognizing that if you want to reap the benefits of physical fitness and whatever else, it has to be routine. There has to be consistency. There has to be commitment. So I can't just coast on effort, whenever it suits my mood. It's the same for investment behavior. You can't just coast on doing what seems kind of fun in the moment. It doesn't really work that way. It has to be about the consistency, commitment, and recognizing, I think the biggest thing here is that self-discipline in your behaviors is actually the only path to freedom. When I think about my relationship with exercise and things like that, the more self-disciplined I've got about just making myself do it even when I don't want to do it, walking outside even when the weather's not good, the more self-discipline I've had, the more freedom I've had with my mobility. And I kind of resent the fact that that's true, but isn't that life? And I think that's the same with investment behaviors. That self-discipline is really the freedom to achieve the goals that you think you're after. And I think the same is with, social connection too.
So for someone who is building a business or leading a high performance team, how do you suggest that they design their own rituals, routines, behavior architecture, as you've mentioned, so that they show up well in both their business and in their life?
I think this would be different for everybody. It's going to look really different. But I think a universal here might be to make sure we start with identifying non-negotiables. I think that might be a way to put it. And then tending to those non-negotiables with flexibility. So I think there has to be a balance of something that's immovable and then having flexibility to kind of have it weather different tides of life. So a non-negotiable for me might be best effort in motherhood, for example. And yeah, sometimes that looks like rich conversation, quality time, playfulness, trips, all that kind of stuff. And then other times it looks like being a vegetable, watching a movie together, or me excusing myself to take a brief walk because I'm feeling a bit irritable. So I think having non-negotiable and identifying that, but being flexible in how we exercise our approach to it is really important. I think ritual is definitely important to me. And I think being able to, it kind of speaks to that self-discipline angle. Having something be ritualistic is how we kind of grow that ability to have self-discipline. And I think another part of that too is to make sure that we've incorporated slow rituals to kind of offset the sort of dopamine-riddled quick fix culture of the 3-second video, the unexamined thought, the consumerism, things like that. So if I put those two things together in a team, I'd be looking at architecture that helps people slow down to think about things from different ways and have that be a practice and a routine. Having people identify those non-negotiables, for example, it could be the set of values or objectives that you have, but being flexible in how you think about approaching them. I think the other part to this that would be important, or at least if I was going to extrapolate from my personal experience, would be that showing up well in life requires us to think about how we are in service to other people. I think if we kind of center ourselves in everything that we do, we're more inclined to be kind of led astray by our own sort of self-absorption and navel-gazing. I think if we're in service of something else, a greater cause, that anchors us in a way to make decisions that are much more serviceable. And we also get more gravity in ourselves to do that. And I think there's a balance, of course, right? I think that having those rituals, being able to ground yourself and anchor yourself so you have enough energy to give those other things that you care about is really important, but not losing sight of making sure that we're in service of something beyond us is important, I think.
So can you talk about some tools that you would suggest people look into, some emerging tools that you're excited about from the standpoint of behavioral science and wealth technology kind of coming together that you think will really help advisors better engage client behavior in the next few years?
Yeah, definitely. I think, speaking of double-edged swords, I think tech is absolutely one of those things. In the wrong hands, I think it can be kind of catastrophic in terms of how we handle other human beings and behavior and things like that. There's sort of a culture around optimizing that I could get on a soapbox around, but I think tech's often used to sort of optimize, but it's what are we optimizing for is the question here. I think that's probably more to do with ethical considerations. Some of the tools I'm interested in as we kind of move into the future of financial landscape are kind of powerhoused by things like AI, which I say that with some reservation. I think we have to couple awareness and AI together to make this work, because AI requires selectivity and human judgment in order to be useful. Otherwise, it's just kind of left to its own devices in a way that I think can be destructive. But I think there are tools, for example, like using, for example, the AI recordings, note takings can be really helpful for advisors in some ways. And then they can run sort of qualitative analysis to pull out themes. Now, I don't think the danger here is advisors just exporting connection with their client, just saying, well, the note taker's taking care of it, so I'll just ask my rote questions, and then the note taker will take the annotations, and then it'll pull out the themes, and done. There's my answer. And I think that would be an incredibly inappropriate use of AI. But if we use note taking, for example, to pull out themes in order to kind of export the ability to not miss detail to AI, so that we can be more focused on the conversation and having connection, then we're using it appropriately. So I think some of those things can be really helpful for advisors, so they can cover more ground in the same amount of time and not miss detail, but also be more focused on the interpersonal connection. I think that's going to be helpful. I think some other tools include, I work with Orion, where we have a lot of behavioral finance tools, and we can use in discovery, for example, to parse out people's life satisfaction, areas that they could use to tend to a little bit more with their benchmarks around money. Education's a big one too, kind of the one-to-many services, being able to, put a webinar on and be connected to people all over the country at the same time to kind of express ideas together, to practice different skill sets. That's a really great way of using tech in this area too. And I think the next 3 to 5 years, having things that are a little more interactive that way is going to be really good. And just also, I suppose, when I think about the future of the financial landscape with behavioral science and wealth tech, that it's getting more mainstream to acknowledge the emotional value of advisors and beyond traditional advisory competencies. And so I think the more mainstream that gets, the more resources we'll have, the more tech will be able to speak to that. And I think that sounds great to me.
So what is one behavioral bias that kills long-term investing discipline? And what's one actionable fix you've used with clients to deal with that?
I think I'm going to go with the availability heuristic on this one. I've thought a little bit about this before. I think it's a question that we circle at in BFI. The availability heuristic just being sort of decisions made on what's most easily brought to recall, and it having sort of an outsized influence to what it really should. I think the actionable fix would be to recognize we're in an attention economy with a dollar amount placed on the seconds we linger on a social media post or website. It's that dialed in. And then having less exposure to the algorithm on purpose. The less exposure you have to kind of the noise, the less likely you are to act on it. So if we're trying to be sort of objective and authentic, I think this is a great place to apply the line that limits defined space, and they shape what happens there. So the actionable fix is to get offline and get some media literacy, I think.
Good advice to end on. Naomi, this has been such a fascinating conversation. Thank you so much for joining us. We really do appreciate it. Before we let you go, though, can you tell us where advisors can follow your work and continue learning from you?
I have a fairly limited footprint, but I am on LinkedIn if somebody wants to find me there, or get in contact through Orion, where I do a number of different bits and bobs.
Awesome. Well, thank you so much, Naomi, for this. I think each one of our questions could have almost been a podcast topic in its own. So hopefully this whetted everybody's appetite to follow you some more. I do have 2 more questions, though.
Let me hear them.
Well, one is because I know you're a music fan. I also know Robin just went to a show. So what was the last show you went to, live performance?
Oh, this is going to almost misrepresent me in some ways. I went to see Ross from Friends. So it was a DJ, actually, a little bit out of step, but I went to see him in a club in Denver. I live close to Denver, and I'm not, we've talked about this before. A lot of bands that I like don't come through Denver, but this was a DJ that I really enjoy and just have, kind of nostalgic almost. I went to that show. What did you just go to, Robin?
Mumford & Sons here in Omaha.
Oh, nice.
Yeah.
Rusty, wait, what did you go to? What's your last show then?
So the one I went to was called Nation of Language. It is a new band, but I think they listened to a lot of their parents' albums because they're very 80s-ish, and that was in Chicago. It was really a ton of fun. We are recording this the day after Radiohead just did their first live performance like in 7 years, and so I kind of wish I'd seen that, but anyway.
Where was that?
I think it was in Madrid. I could be wrong. I've only read articles on it, so you'd think I would know where they played at. It was somewhere in Europe. But
back on the circuit.
All right, one last question. So I'm sure you'll have a quick answer for this, though you have no idea what I'm going to ask, is we're looking at you right now, and you have like a gazillion books behind you. So the question is, do you have a favorite book, or is there a book that you have gifted the most off that shelf?
Oh, that's a good question. Also, now I'm self-conscious because you're noticing how wonky my shelves are.
They do look like Dr. Seuss books, though, actually, now I look at them.
Look a bit. They're just props. They're not real. I'm just trying to look intelligent. That's a really good question. Also, those are 2 questions in one, which is difficult. The book that I've gifted the most, honestly, I'm on a bit of a soapbox about Freud, and Civilization and Its Discontents is a book that I've probably gifted the most because it's very short, and I have some sort of bee in my bonnet about evangelizing for Freud because I feel like he gets a bad rap.
That was like last week we had a guest that I talked about a book I used to gift the most. It was a book on economics, but nobody really said, Rusty, this is awesome. Thank you. I mean, I'm sure a lot of people get a book on Freud and probably say, thank you.
They don't say thank you. I don't say thank you for that. I think the central premise of his argument is so relevant for modernity though. So I'm just going to keep pushing it even if nobody says thank you. We don't always know what's good for them. We've talked about that in this podcast too.
Robin, I've never asked you that question. Do you have an answer for that?
A book I've gifted a lot is the Book of Joy, which is with the Dalai Lama and Archbishop Tutu. It's like a conversation that they had, and it's like,
I've read that book. It's like kind of old, isn't it? Yeah.
It is kind of old.
Well, my book right now is it's kind of whatever the latest Ryan Holiday book is, because I have sons, and it's always an easy book to give that, because I know they actually read it and they say they like it. So anyway. Well, Naomi, thank you so much for your time today. And, in hindsight, we probably should have just gone with our 30 questions right at you,
Just quick fire? Yeah.
So, exactly. So what we'll have to do is we'll have to have you back on sometime. So thank you so much for your time today.
Of course, I would love that. Bye.
We'll be back next week. Thanks for listening to Invest Well, Be Well. Let us know what you think. And if you like what you hear, don't forget to subscribe.
This podcast is hosted by Rusty Vanneman and Robin Murray and produced by Garrett Crosby.
If you have feedback, guest suggestions, or just want to connect, please visit my website, rustysbridge.com, or email me directly at rusty@rustysbridge.com. Until next time, invest well and be well. This episode of Invest Well, Be Well is brought to you by Orion Capital, led by my friend and colleague of nearly 10 years, Shana Sissel. Shana was named a top 20 wealth tech CEO in 2025, and it's no surprise. She's passionate, does the work, and knows asset managers, portfolio allocations, and alternatives like few others in the business. She's authentic, tough, and deeply cares about all her stakeholders, the kind of character you'd expect from the daughter of a police officer. If you want an investment manager who combines deep due diligence with innovative solutions and alternative investments, please check out Orion Capital at orion.capital.com.